welcome everybody here tonight. We want to congratulate you guys for continuing to take the first step towards home ownership, and that really is becoming educated and getting that foundational knowledge that you need to really succeed as new homeowners. Tonight we're hosting our 7th webinar, and we are so excited tonight to have one of our long-standing volunteer educators, Megan Dixon, who of course you guys see on your video tonight. Hey Megan.
Hello.
And I'll let Megan introduce herself real quick, share a little bit about her.
Yeah, so I am Megan Dixon. I'm a community mortgage specialist with BB&T, now Truist. And what I get to do is help first-time homebuyers just like you all achieve your dream to becoming homeowners. You know, you can't tell by looking at me, but I am bilingual. They call me La Guarita que habla español.
Yo también.
Yeah.
We have that in common, Megan and I. So lovely. Megan is being humble. She hasn't mentioned the fact that she has actually generously volunteered her time as an educator with Dallas Habitat in our program for many years now. And so Megan, we just want to say, publicly thank you for choosing to give back by, really empowering people to take this really important financial step. We appreciate you.
Absolutely. Dallas Habitat for Humanity holds a special place in my heart. Habitat for Humanity, I don't know if you know this, Blaine, but they helped me when I was growing up. So it's a very special place.
We love that. It's so special. And, taking that power of, knowing what it means to have a safe and a stable place to grow up and to call home, right? And then say, I really want to empower other people to do that for themselves as well. We just love that. And so, we appreciate you being here. To all of our participants here tonight, I see so many familiar faces. So we know that y'all know these housekeeping rules, but we'll run through them real quick anyway. As we always do in our webinars, tonight is going to be an hour-long webinar. We may go just a minute, over because we got started a couple of minutes late. That's on us. And we are going to host a moderated question and answer session at the end of the presentation tonight. So as always, we really encourage you guys, if you have questions for Megan, questions on this topic, please make sure that you send in your questions to us. We are going to make sure we get through as many as we possibly can tonight. And you're always welcome to drop those questions in the chat, but it's definitely preferable on our end if you would be willing to put those in the question and answer box that you see on your screen. And that allows us to make sure we're managing those questions appropriately tonight. The other thing I do always want to mention is that we are recording tonight's webinar. And the benefit of that is that if you've got to hop off early, or if you know somebody that intended to take this webinar that wasn't able to join in live, no problem. We record these webinars so that they can be archived on our YouTube channel and also on our website. So they will live on into cyber eternity. And so they're here for anybody to take advantage, of course, at no cost. So with that being said, Megan, I'll turn it over to you if you'd like to share your screen and start our presentation.
Sure. So let's see here. Share screen. There we go. Okay, can everyone see my screen?
I still see you on my end.
Hold on. Okay, I think it's something you have to give me permission for, Blaine.
Ah, you may not have. Okay, let's see. I apologize, Megan.
Okay.
She is tonight. I'll tell you what I will do. I'm happy to share the screen on my end, Megan. I will prompt through that way. Let's see. Okay. Just give me one moment to pull that up for y'all. Okay. Can you see my screen?
I can.
Okay, lovely. Can
Right.
you see you? Wonderful. We went through some of this already.
Yeah.
Okay. Can you see this, Megan?
So that's what we'll discuss.
Yes.
Okay. Let me. Okay. Are we ready, Blaine?
Yep. Ready when you are.
All right, so here we go. So today is just going to be kind of a high-level overview of what's considered to be mortgage ready. Now, I will share with you, as a mortgage lender, you are welcome to apply to kind of see where you're at in terms of being ready to purchase a home. Everyone can legally apply. These are just to kind of explain the basic qualifiers, and they won't touch on every single circumstance. So if you have something that's really specific to you and your situation, you can drop it in the chat box, or you can get with us personally later if that's something that you don't want shared in an open forum. But today we're going to share with you like questions to ask yourself before getting started. The home buying process is not an overnight process. So this is really geared to just kind of get you thinking, am I ready to buy a home? Okay. And click next. Okay, we're going to be analyzing your employment and your income and factoring in your debt, because that's very important, making sure you can afford a home. And then reviewing your credit. Where does your credit need to be considered mortgage ready? And then savings. Savings is very important, especially when we're talking about first-time home buying and all these programs that are out there, because you might think to yourself, well, I talked to this one person who used down payment assistance, so I really don't need to save. Well, that's just not true. We'll talk about that a little bit later, but you will need to save some of your own money or some other options for you to have access to outside of the down payment assistance funds. Okay. All right, so questions to ask yourself. When do you plan to buy a home? I think we were going to do a poll for this question.
We are going to do a poll. Now we'll run that right now.
All right, so when do you plan to buy a home? You should see an option pop up on your screen, and just choose one of those. If you're ready to buy right now, you're ready to apply maybe 3 months from now, or 6 months, a year, or maybe just a couple years or more down the road.
We've got 20 out of 27 people have voted. That's awesome. We want to hear from everyone.
Absolutely. Okay.
Okay.
And do we see the results of the poll?
Yep. So let me share these results real quick. I see a couple more votes coming in.
Yeah.
Hey, we're going to call it. Okay. Let me share these results.
Awesome. Okay, so as you can see, everybody's journey is a little bit different, and that's okay. It's like we said, this is a journey, and it's not an overnight process. So we're here to help you, continue on that path to becoming a homeowner.
That's awesome. Okay.
Okay. If you currently have a lease, when does it expire? That really helps your lender and your realtor know where you're at in the process. If your lease expires, maybe 9 months from now, Well, if you start shopping for houses right now and you just find your dream home and you want to go ahead and place an offer, well, then you need to make sure that you have the funds to cover if your landlord is going to make you pay to break your lease. But if your lease ends in, let's say, maybe 2 or 3 months, then now is a great time to apply to see kind of where you're at. If you need to work on your credit some, maybe you pay off some debt some, so that you can really be ready whenever you start house hunting, because the whole process from start to finish, from whenever you go under contract until closing day, on average takes about 30 days. It depends on the loan program. Okay. Where would you like to purchase? You don't have to have a specific address in mind per se, but if you have a part of town that you're thinking about, then maybe there's a special program that's available in that area. For example, I am an approved lender for a particular program that offers in the city of Dallas. And I'm for another one within the city of Dallas plus Tarrant County. So it's really important to share with your lender where exactly you're thinking of buying. And they can also pull in the estimated property taxes based on where you're thinking about buying. Okay. Are you a first-time home buyer, or do you own another property? So some of these programs, most of them, they do require that you are a first-time home buyer, and most of the programs define that as someone who has not been on title of another home within the last 3 years. So you'll want to have a discussion with your lender on whether or not this program allows you to own another property. A comfortable, last one, comfortable monthly payment for you, including taxes and insurance. Okay, so you need to be prepared. If you're renting right now, renting does not include things like homeowners insurance and property taxes. Okay, so you need to be prepared to pay maybe a little bit more, maybe a little bit less, kind of depends on your current situation. But I would say as a good starting off point, you need to be prepared to pay at least $1,200, including property taxes and insurance. It might be a little bit less, might be a little bit more, but $1,200 is a good, just kind of general starting off point. Okay. All right. Employment. What do you do for a living? Okay, so maybe your particular industry has special programs like teachers, for examples, or first responders. There's some grant programs that are available for industry-specific occupations. Next. All right, how long, let's see, oops, covering it, there we go. How long have you worked at your job? If less than 2 years, were you previously in the same line of work without any gaps in employment? Okay, so you'll hear your lender ask you for your job history. And depending upon the loan program, but in general, it's a rule of 2. So we're looking at the last 2 years of your employment history, making sure that you've held a stable job, or if you've changed jobs, is it in the same line of work? And if it's not in the same line of work, then you need to talk to your lender to see what the loan program requirements are, because most of them require that you be in the same line of work for at least 2 years. So for example, if you are a nurse and you go to work at one healthcare facility to another healthcare facility, and you're getting paid the same, like W-2 to W-2, then that's okay. But if you're a nurse and you leave to go be a teacher, well, nursing and teaching are 2 completely different lines of work. So you'll want to make sure that, again, you have that conversation with your lender about what the requirements are. Now, if you've been in school for full time, then we can use the time that you've been in school to the time you started at your current job. If it's in the line of work that you studied, the field of study, then we can use that to make that 2-year history complete. Next. All right, W-2 or 1099 or both. So again, that rule of 2, you want to make sure you have a history of earning W-2s, or if you're doing contract work, you're getting 1099s and reporting income for at least 2 years. Because a lot of self-employed or contract work, they want to write off a lot of their income so they don't have to pay as much taxes to the government. However, you need to make sure that you're reporting enough to be able to qualify for the loan. Okay. Have you filed taxes for the last 2 years? Okay, so how many do we think? Rule of 2, we're going to ask for the last 2 years of your tax returns, especially if you are self-employed, if you have overtime income that you want us to consider, if you receive regular bonuses for the last 2 years, or if you receive commissions for the last 2 years that you want us to consider for qualifying. So make sure that you are providing both personal and business tax returns to your lender, all pages, all schedules. It's not just all just of this page, that's all they need to know. No, we've got to see the whole thing. Okay.
Megan, this is Blaine. I'm jumping in real quick. I have to jump in on this topic. For all of our listeners who are joining us tonight who are in the Dallas Habitat program and working with one of our counselors, this is incredibly important information. This is exactly why Porfirio and Aretha ask for lots of information when it comes to taxes, and Porfirio and Aretha are combing through those tax returns and W-2s and 1099s with a fine-tooth comb, because our goal as housing counselors is to make sure there are no surprises, no hiccups that hit you once you begin that mortgage process with a loan officer like Megan. And so to make sure that we know this is what lenders are going to be looking for. These are the documents that they're going to review and how they're going to review them. The value of housing counseling is that we can do that in a safe space so that when you walk in and you speak with somebody like Megan, you feel confident and comfortable about that. But Megan, great points about, taxes and how those are heavily scrutinized, and rightfully so. Taxes, I think, are one of the things in our experience that, clients often underestimate the importance and the impact of how you file your taxes and getting approved for a mortgage.
Absolutely. And by all means, I'm a mortgage lender. I'm not a tax professional. So if you have tax specific questions, want to make sure that you're reporting enough income, you need to speak with your CPA or your tax professional, whoever you use to help you file your taxes. Okay. All right. If you're self-employed, have you claimed any losses? I think we touched on that a little bit. Again, it's important that you are reporting enough income. While those tax breaks might be nice, but if you want to buy a certain, price point of home, you've got to make sure that you're reporting, enough income. Next.
And Megan, I'll ask this question real quick. From your perspective on number 5, if self-employed, have you claimed any losses? What about individuals who wouldn't consider themselves self-employed, but on their taxes have filed a business loss? Does that affect them?
Yes. So we take in consideration everything that is reported on the tax return. So if maybe you've got like a little side business and you have a Schedule C, for example, that's a sole proprietor form on a personal tax return, like a 1040 form, you're going to look at certain lines, and we'll determine on what you reported, what your losses were, But absolutely, if you have a little side business and you're claiming losses, that does impact how much you qualify for.
Yeah, I would say we see this quite a bit with our clients as well. And it's just a matter of, education is power, right? To Megan's point, Megan's a loan officer, not a tax professional. Well, a lot of individuals go and see their tax professional during tax season. And sometimes, recommendations are made to file deductions on things that can really have a really big impact on your ability to qualify for a mortgage or the amount that you'll need in order to be able to have purchase power in the marketplace. And so it's about educating yourself and knowing that the more, losses you take on taxes, the less purchase power you'll likely have when it comes your time to get ready for mortgage.
Absolutely, absolutely. Okay, what is your annual income before taxes? So that's very important. Before taxes, that's what's called gross income. So that is what a lender is going to use to evaluate how much you qualify for. But when you're creating your budget, remember you're creating your budget based on your take-home pay. We call that net income. Okay, and so whenever you're creating your budget, you want to make sure that, okay, this is the lifestyle that I would like to live. Like I have a certain subscription, or I have, these little extra things that I like to do. We have something called house poor, where all you can afford to do is stay home and pay your mortgage because you have maxed out your budget. Okay, so one of the things that I love about working with Dallas Habitat is they really sit down with you and create a budget and a spending plan, go over all of your expenses, figure out some things. Maybe I don't need this, maybe I can cut back here, and help you create a budget. But it's important to know that the lender, we're going to use your annual income before taxes. Okay, and that is what we use to determine your income limits for qualifying purposes for the down payment assistance programs, because most of them, if not all of them, do have income restrictions, and they're very specific to each program in each county, and it's based on where the property you're buying is located. But that's an in-depth conversation you want to have with your lender, making sure that you're within the income limits for all of these programs. Okay. Do you receive commission, bonus, or overtime? So we touched on that a little bit earlier, but we want to make sure that if you want us to consider any of this type of income, then it has to be consistent for at least 2 years. So if you've only worked overtime, maybe a few hours here and there, we really wouldn't consider that as qualifying income. It has to be a set number of overtime hours each week. And the same for commission and bonus. If you just received it maybe once here or there, but you haven't really received it consistently for the last 2 years, then we need to make sure that you're receiving it consistently for 2 years. Now, if it's an annual bonus and it's regular, then that's one thing. But if it was just something small and doesn't really impact, but again, that's an in-depth conversation you want to have, with your lender. Okay, part-time employment. Okay, what do we say? Rule of two. Rule of two. So we have to have at least a 2-year history of working part-time in order for us to count that income. So let's say you're already working a full-time job and you start working a part-time job maybe 6 months ago, and you want us to count both. Well, we have to have a 2-year history for both employment. Okay, because working full-time and working part-time is really demanding, and we have to make sure that you're going to be able to keep up with those demands we have to foresee the income continuing for at least 3 years. And we do that by looking at the past 2-year history to project a 3-year future. Okay. Your debt. Okay, so your debt is a big impact on how much buying power you have. Okay, so what are your minimum monthly payments on your current liabilities? So things like your car payment, your credit cards. And your credit cards, we would ask for what is your minimum monthly payment, not say, oh, I just pay it off every month, or I pay $100, but the bill only comes for $35. Well, we're going to ask for those minimums because that's what's going to show up on your credit report is those minimum monthly payments. The same thing for student loans, and we'll get into student loans here in a bit. If you've got personal loans, let's say a payday loan or a title loan, how much is that monthly payment? How much do you have left on it? So things like that will be taken into consideration when factoring in how much buying power you have. And you have to really stop and think when you're creating your budget. Say, okay, I have this, really nice car. It costs me, $500 a month. Sometimes a little even higher. Do I want this really, really nice car, or do I that's going to lose value over time? Or do I want to have a house where I can pass that on and create generational wealth? Because owning a home in this country is one of the fastest ways to accumulate wealth. I mean, it's not guaranteed that the value will go up, but most of the time it does. We live in Texas, which is a very stable market. There's no predictions in the future and exactly what will happen, but just, historically speaking, what we've seen, Texas is a very stable housing market. Okay.
Megan, I cannot allow us to proceed without saying something about debt and especially car payments.
Yes.
From a housing counseling perspective, Dallas Habitat will say the number one thing, truthfully, that we see that holds people back from qualifying for a mortgage when it comes to debt specifically is car payments. Okay, we see all too often that, we get excited about getting all of the debt all at one time. So we see this trend quite a bit when people get excited about qualifying for a mortgage and they know, okay, my credit's in good shape, my credit score has increased, great. Now I need a new car. Getting a car payment has a huge impact, as Megan has, explained, on your ability to qualify for a mortgage for a lot of reasons, but specifically because it can throw your debt to income ratio, your DTI, as Megan and loan officers would call it, out of whack, which indicates to lenders you owe too many other debts to take on this amount in a mortgage payment. So our 2 cents at Habitat is, if your car is doing okay and you do not need to get a new car payment and you're seriously committed to home ownership, as Megan said, make that a priority. Invest in an appreciating asset like home ownership versus sinking money into a depreciating asset, because it can definitely make a big difference in terms of your purchase power.
Absolutely, absolutely. And I have another presentation that I do called the do's and don'ts on your journey to home ownership. And one of the big, big no-nos is if you're in the middle of the loan process, do not take on any new debt. But that's another story for another day. All right, student loans. If you have student loans, we're going to use the payment that is reported on the credit report in your debt to income ratio calculation. If your student loans are in deferment, well, all that means to a lender is that you're not making payments right now, but you're going to have to make a payment sometime. And we use what we call investor guidelines. Investors like Fannie Mae, Freddie Mac, maybe you've heard of some of those agencies, those government agencies. We use their guidelines to tell us how do we calculate what the monthly payment will be once those loans come out of deferment? In most cases, the current guidelines and in the world of mortgage, guidelines change often. So if you're watching this recording today, it could change. I just want to throw that out there. But as of today, the guidelines state that, well, at least for most loan programs, they state for loans in deferment, student loans in deferment, it's 0.5%. So we're going to take 0.5% of the outstanding balance to calculate what will your monthly payment be once it comes out of deferment. And that's what we'll use in your debt to income ratio calculation. Okay, debt to income ratios. So we compare all of your monthly payments. So we gathered, because this is kind of a progressional thing here. So we've gathered all of your monthly payments, and now we're going to compare that to what your gross income is. And that's called the debt to income ratio. And debt to income ratio limits, they vary depending upon loan program. And a lot of the down payment assistance programs, they have their own set of debt to income ratios. So we don't really want to get into specifics just because there's so many different programs out there. But that's a conversation that you want to have with your lender just to make sure that you're going to be within those limits. And the reason that these limits are in place, I don't know what the demographics of our audience are here, but back in 2008, there was the housing market crash where people just put whatever they wanted basically on applications. They said, oh, you want a house for this much? Well, then you need to write, this is how much money I make on your application, without really sourcing anything. They didn't ask for W-2s or pay stubs or anything like that. They just kind of took your word for it. And people got into homes that they truly couldn't afford. And then people were going into foreclosure left and right. And it caused the housing market to just completely collapse within itself. So the government has put in safe holds to ensure that that doesn't happen again. And so if your lender is asking you for certain things, it's not that we want to be nosy and get all into your personal business. It's just we have to do our due diligence and abide by all of these regulations to ensure that we're doing the right thing for you. We want to make sure that you're going to be able to not only get into a home, but we want to make sure you're going to be able to stay in that home and make those monthly payments. Reviewing your credit. This is always a fun topic because it can go a million different ways, but that's okay. We're just going to touch on some basics here. If you have more specific questions, we can certainly touch on that. But we're just going to talk about some basic credit qualifiers. Okay. Have you had any late payments or collections in the last 12 months? So again, we look at the past to predict the future. So we're going to review your credit report to see if you have made your payments on time, and if there's anything on there like any collections or late payments in the last 12 months. And that does include medical collections. A lot of people have this misconception that medical collections don't count. Well, that's just not true, okay? Because it is part of what creates your credit score. And all your credit score is a snapshot in time, okay? So it just tells us what your credit looks like when we pulled that credit up in a few years back. Okay, so just want to make sure that you're making your payments on time, and if there's any collections, that they're not within the last 12 months. Have you declared bankruptcy in the last 7 years? Okay, so that's a question that will be on your loan application. again, we look at the past to predict the future. So we just want to understand what happened. We're not, here to judge or anything like that. We just want to understand, what led to a bankruptcy, and have you worked on, rebuilding credit since then. I can't speak for all lenders, but I can speak for our guidelines. And our guidelines state that if you've had a bankruptcy within the last 4 years, then that would be considered a deal killer. We wouldn't be able to move forward at that point unless it was due to extenuating circumstances. And I will tell you that investor guidelines, Fannie Mae, Freddie Mac, they do not consider divorce to be an extenuating circumstance. Same thing with foreclosure. We want to review your credit report history. Maybe you had some trouble in the past. Again, we're not here to judge, but it's that 4-year mark again, or 2 years due to extenuating circumstances. Okay. What do you think your credit score is, and who do you use to monitor your credit? We're going to do another poll real quick. Say, who do you use to monitor your credit? We have the options of Credit Karma, you use your bank, maybe your credit card company tells you, or you use something else. Take a sip of water while everybody's answering.
We're about halfway there. All right. Few more seconds. Okay. We're gonna launch these results.
Okay, I have to say, I am not surprised. Credit Karma is most common that people use. It's free. It'll, give you an answer pretty quickly and tell you what's on your credit report and all that good stuff. If you've heard of the term FICO score, what I like to call the score that's used by Credit Karma is the FACO score, because it is not real. So what they use is something completely different. It's a completely different algorithm. It's called the Vantage Score, and no lenders use that, especially for mortgage purposes. There's more than 60 versions of the FICO score, and what you're probably most used to seeing is your FICO score 8. And those are things like what your bank is going to provide you, because I know a lot of banks, including ours, they offer you a free credit score. They're going to offer you that. It's the same score for your credit cards, is the FICO score 8, and sometimes for car loans. It just depends on the lender. But that risk level is completely different than a mortgage score. So if you think about it, with a credit card, you're using it, paying it off, using it, paying it off. A car loan, you're going to repay that in about 5 or 6 years. Okay, so that's one level of risk. But with a mortgage, you're going to be paying that back over the next 30 years. Okay, and so that's a completely different level of risk. And so the only true way to find out your mortgage score is to have a mortgage lender pull your credit, okay? Now, if you are shopping around at different lenders and want to see, compare their programs and things like that, if you apply with a few different lenders within a 14-day period, that's within 2 weeks, then it will show up on your credit report as multiple inquiries, but it will impact your credit score as if it were only pulled one time. Okay, did everybody catch that? Within 2 weeks, if you want to check out different lenders, have them pull your credit within 14 days, and it'll impact your credit report is only one time. Okay, and it's also good to have a mortgage lender pull your mortgage scores so that you know exactly where you stand. So if you are just kind of wondering, it's like, okay, how much do I qualify for, or do I have any late payments? Are there any collections on there? How do I know? Like, what is my true, mortgage score so that I know, do I qualify for these programs? Well, that's why it's important to talk to a trusted lender and have them run your credit. Blaine, did you want to chime in there?
All I would add is, again, knowing we have a lot of Habitat clients tuned in tonight, if you're working with Porphyria or Aretha in our housing counseling program, we do something that's generally speaking unusual. To Megan's point, 9 times out of 10, when you get your credit pulled, it's considered a hard pull and it does impact your credit. You want to be very cautious about doing that. At Dallas Habitat, because we do homeownership counseling, we review credit quite a bit with our clients. We do pull a tri-merge credit report that includes your FICO score and does not impact your credit. And that's designed so that, again, you know all of the facts on your credit and are really well prepared. No surprises. We know, to Megan's point with the FICO score, which I love, and I'm probably going to borrow that, Megan, that Vantage Score, Credit Karma is comparing apples and oranges to a FICO score. So if you're, planning your mortgage readiness around that score, it may not serve you well. So you want to make sure you do your due diligence and speak with a lender or speak with your housing counselor and make sure you're looking at FICO.
Absolutely. So credit score requirements for most loan programs. And I'm just going to speak with our guidelines because every lender is different. Every lender is going to have different programs, different guidelines. Most of our programs do require a 620. Some of them do require a 640 or a 660. It just depends on the different program. Now there are, some programs out there, let's say VA, for example. VA technically doesn't have a minimum credit score. And we go by what the automated underwriting system response tells us. But just as a general starting off point, you want to have, at least a 620, 640 kind of as a starting off point. Now, some of these down payment assistance programs, I will tell you, in the midst of everything that's been going on, they've really taken a closer look at their guidelines, and a lot of them have increased their minimum requirements to 640. So you want to just make sure that you have a good solid credit history. Again, no late payments, no collections, make your payments on time, stuff like that. And then make sure that you're not building up your balances on your credit cards, things like that. Okay. Savings. Okay, so how much do we need to save? Let's talk about it. So we're going to ask you things like, how much do you have saved in the bank? And how many months do you think we're going to ask? Rule of 2. We're going to ask for the last 2 months of your bank statements, all pages. So we want to make sure that we don't see anything, out of the ordinary. And that, again, goes back to my do's and don'ts on things that you should do and shouldn't do. For example, cash. Cash is a big no-no in the mortgage world. You want to make sure that everything is accounted for. Okay, mattress money. That's what we refer to in the industry as cash. So if you have mattress money, like money you have saved at home that you're planning on using to buy a house, then you need to talk to your lender about what to do with that cash so that you can use it. There's some very specific things that you need to do in order to be able to use that cash. Don't deposit it to your bank account. Okay. Do you have a 401k or a retirement account? Okay. How many of you knew that you can use your 401k for the purchase of a primary residence? Most employers have that clause in there. It's called the hardship withdrawal, and that's one of the circumstances that they allow you to take money from your 401k without a penalty, is if you're going to use it to purchase your primary residence. Okay. And if you do, we're going to ask to see a statement so that we can see what the value is. And we were looking for what's called a vested balance. That means how much of that balance do you have access to? Okay. If it were necessary, would you be able to get a gift from a family member to assist you with closing costs? Okay. So some programs will allow you to borrow money, well, not borrow money, your family member to give you a gift to help you with down payment, with closing costs, and some programs, they do have a limit, and some they do not. So that's a conversation you want to have with your lender. I say all of this to say, how much money do we really need to have to be considered mortgage ready? Well, again, we talked about some of the down payment assistance that's out there, but you've got to have money for upfront costs. So whenever you go under contract, there's going to be a few things that you have to pay for upfront. The first one is called the Earnest Money, and that's usually 1% of the sales price of the home, and that's a cashier's check or a check that you write out to the title company. And that the title company is going to hold that money. And then at closing day, that money gets credited towards your down payment or closing costs. Okay. And then you have something called the option fee. The option fee is something that you pay directly to the seller that says, while we're in our option period, you cannot go under contract with anyone else to buy this house. And during that option period is whenever you're getting your inspections. Inspection is something you pay completely on your own. It's not credited towards closing costs, but it's so that you do your due diligence in knowing exactly what you are buying. Some loan programs don't require them, but I always recommend to my clients, get an inspection. You don't want to buy a house without one. You want to make sure, are there any foundation problems? Are there any roof problems, electrical problems, plumbing problems? The big stuff, not so much the cosmetic stuff that's maybe a Home Depot trip or something like that, but just the big ticket items is what you really want to look out for. We like to call that structurally sound, to make sure that you're going to get into a good solid house after you move in. Okay. And then, oh, we're not done. And then also the appraisal. So the appraisal is a fee that you pay directly to the lender, and the lender will choose an appraiser to go out and look at the value of the house. So the inspection looks at the condition of the house. The appraisal looks at the value of the house. So all together, that adds up to be, roughly about $3,500, $5,000. So that's about how much you need to have set aside in one of these things that we talked about, whether it's in your bank account, if you have mattress money, talk to the lender first, if you have a 401k, or if you have a gift. So you want to have $3,500, $5,000 as a starting off point of your own money. Okay. Okay, other things to consider. So are you a U.S. citizen or a permanent resident or a non-permanent resident? So if you're a non-permanent resident, we will ask what class of visa that you carry. So it depends on the lender which types of visas that they work with. So you'll want to have a conversation with your lender about that. Okay. Do you have a social security number or an ITIN number? It depends on the lender. Not all lenders work with ITIN numbers. So you want to make sure that you're working with a lender who does accept ITIN if you have an ITIN. Okay. Will anyone else be on the loan with you? Texas is a community property state, so if you are legally married, then your spouse must be on the title of your primary residence. They do not necessarily have to be on the loan, but they do have to be on title. And it depends on the loan program. In some of the down payment assistance programs, some of them go by whoever's on the loan, and we will only look at that person's income, or they consider the entire household, even grandma and grandpa. We take a look at everybody who's in the household to see, okay, what are the income that everybody's bringing in to make sure it's within those limits. Okay. All right, I think we're ready for some questions.
Yes, we are. Okay, so here we go. Our first question is, which credit bureau is mostly used by mortgage lenders?
Which credit bureau? So we use all three, and we use what's called the middle score. So it's not your highest score, it's not your lowest score, it's the score that's in between.
The middle score. I get that question a lot. Megan, what if someone is receiving disability or SSI or has child support? Are any of those types of income acceptable for mortgage lenders?
They are, absolutely. So especially Social Security or disability, those are considered non-taxable income. And most of the time we are able to gross it up by about 25% to account for all of the income. And child support, it depends on, investor guidelines, but we have to be able to prove that it's been being paid consistently over a certain period of time. And it has to be most of the time court ordered. It depends on investor guidelines.
Great, great. We have a question from the group that's a Habitat specific question. I'll go ahead and take that one. The question is, if you're applying for the Habitat program and you're married, does your spouse have to be on the loan? The short answer to that is your spouse does need to be on your application. As Megan mentioned, Texas is a community property state that affects anyone living in the state of Texas. So we do need to be privy to that information. We also would include that person from our programmatic perspective, but they're not necessarily required to be on the loan with you, like Megan mentioned. So good question. Our next question from the group is, what if you have to buy a new car and have zero debt? So I think that the question is really saying, if you have no choice but to buy a car, do you still have an opportunity to qualify for a mortgage if you have no other debt?
So it really depends on what your monthly payment is going to be. So you'll want to ask your lender, how is this going to impact my buying power? And they'll calculate that in your debt to income ratio.
Absolutely. We have an interesting question from the group. We have a participant who said they have recently inherited some money that is currently being kept in an IRA and earning interest. And this participant is planning to use a portion of that money as a deposit to purchase a home. Would that be okay?
So it really depends on what the guidelines are for that IRA. Again, I'm not a tax professional, but most of the time, if you are younger than the minimum age to start taking draws on your IRA, there would be some kind of tax implication for taking it out early.
Yes. Excellent. Our next question is regarding COVID-19. I think this is a fantastic topic right now, and people want to know, what's happening right now with everything going on with COVID. Are lenders still working with people or being flexible with people if they, have lost their job, but had previously had steady work history? What should buyers need to know today about qualifying for a mortgage?
Okay, so I mentioned earlier that mortgage world guidelines changed, and this is kind of unprecedented times for the entire world, and we have seen guideline change after guideline change after guideline change. So I would say really just talk with your lender about what your options are. Most of the time, they're going to require that you regain employment before you apply to be considered eligible.
Excellent. Let's see, our next question is, looking for a more general question. Let's see. Oh, good question. If something goes wrong with your home inspection, will you receive that money back?
Okay, so this is something that your realtor can help, negotiate and protect for you. That's why we have that option period. So if something happens in the inspection, saying, wait a minute, there's some problems with the house. So Mr. Seller, will you fix these? And that's why you're going through negotiations with your realtor. In the option period, they're going to negotiate on your behalf with the listing agent. And if you and the seller come to an agreement, okay, you can move forward. If you don't come to an agreement and the seller says, you know what, I just want to sell the house as is, I don't want to do the repairs that you're asking for, well, then that is a reason for you to be able to back out of your contract, and you would get your earnest money back, but you would not get your option money back. And option money is usually between $100 to $300.
And I will just say, I've got to make a plug for this, but we did have a webinar that we hosted with two of our preferred realtors, and that webinar is available on demand. To Megan's point, that's really in, realtors' wheelhouse. So we would suggest, tune in if you have specific questions on that part of the process, what, amount of your upfront costs you could recoup and what you don't recoup. We go into detail in that webinar about that. Let's see, we have a question about, if I am the primary buyer, does the co-buyer have to have a 2-year work history as well?
So all buyers have to meet the individual requirements in order to be on the loan. So the short answer is yes, but maybe you on your own can support the loan without that other person, and we can still add them to title, so they'll have ownership in the property, but they may not necessarily have to be on the loan.
Right. Excellent. Okay, back on taxes and self-employment for just a second. Megan, what if you just started a business this year, you haven't filed taxes yet, right? Because we haven't made it to the end of the year. What would be required to show documentation, if anything?
Okay, so what is the rule that we talked about? Rule of 2, has to have at least 2 years reporting income. So as a business just starting out, my fiance, he just started a business, last year, and he didn't show any income for this year's taxes. So he wouldn't be able to use that, for example. But yeah, you have to be able to report income for at least 2 years for us to consider it.
Absolutely. Let's see. If you have child support being sent to and documented in your bank account from the person who owes, would a letter of explanation be needed for those deposits?
So, okay, so it's not court ordered is what I'm understanding. So it depends on, the lender. Maybe they can do a manual underwrite and do an exception. But if it's going to be like a Freddie Mae, I combined them, Freddie Mac or Fannie Mae backed loan, most likely no.
Mm-hmm. Let's see. And we have just a couple more questions left.
Sure.
Oh, great question. What exactly is down payment assistance?
Okay, so there are different types of down payment assistance. Some of them are a true grant where you don't have to pay the money back. Or sometimes it's what's called a second lien on a property. And most of the time those are forgivable. Sometimes they're not. It just depends on the loan program, and you want to ask your lender, what are the stipulations whenever I accept this money? Do I have to pay it back? Do I have to live in the property for a certain number of years and it's forgiven? Or do I just have to pay this money back at some point no matter what?
Yeah, all great questions. So I think that concludes our question and answer session this evening. Megan, we really want to thank you for all of your expertise and your insight tonight. This is such an incredibly important topic. So we thank you for making time and sharing your pro tips with us. To the group, before we end tonight, the last thing I do just want to share, if you have not heard Habitat's big news, we are planning a very exciting virtual event that we're hosting in 2 weeks. It will be held also on Zoom on Saturday, June the 27th from 10 a.m. to 1 p.m. If you didn't know, June is National Homeownership Month. So of course, that's reason for Habitat to celebrate. And this will be our 4th annual homeownership fair that we host to really empower, educate, and motivate first-time homebuyers. And this year, of course, with COVID, change of plans, but it's not, getting in the way of us making sure that we still follow through with our mission. And so we have moved this event online. Registration is live. Of course, you can find information about this on our website, on Facebook, and our social media channels, but we certainly hope to see everyone there. We're gonna have some really great breakout sessions on topics like qualifying for a mortgage. We're gonna bring back some realtors to talk about shopping the home market right now, especially during COVID-19. And for our participant who asked the question on down payment assistance, we are hosting a down payment assistance expo. So I would really encourage you guys, join us, come and learn about all of these important topics. And of course, like everything else we're doing online, it's free. It's open to anybody, anywhere. So we thank you so much for participating and continuing to join. We do have 2 more webinars that are planned in July. They're live up on the calendar. If you check out our webinar calendar, you'll see those and be able to register for those. But we hope to see you guys there. And Megan, we can't wait to have you back.
Absolutely, my pleasure.
Yes. Well, thank y'all so much. You guys enjoy your evening.